Thank you so much. This is Gurpal Singh from Gursur Education. Once again, I welcome you to our official channel. This is Professor Gurpal Singh, and from Gursur Education, as you all know, that we have continues the series regarding financial management in commerce and management syllabus for NET JRF examination. So this series has so many lectures which are very conceptual, and number of lectures we have already gone through. So in this video lecture, we are going to talk about cost of capital. That is the very important thing to understand from our exam point of view, as well as from the point of view of your basic understanding regarding if you wish to start any business, if you wish to calculate the total cost which you have to pay to your investors. So the cost of capital is concerned with the cost of acquisition of funds or investment so that you can make investment in your business. You know, when you open a business organization or any kind of venture enterprise, you need funds. Regarding that, we have already delivered a separate lecture that was sources of funds, and I have taught you in detail what are the different sources from which you can obtain the funds required. And after that, most important thing is that you have to decide what should be the proper mixture of your debenture and equity so that your value of the firm could be maximized and the overall cost of capital can be decreased. So at that time, I told you that after this specific topic, we shall be talking about the cost of a capital. Now it's the turn of that. So this is that whoever has invested in your business, whether they are equity shareholders, whether they are preference share capital, whether they are debenture holder, they all expect something in return. Okay. So if I am giving you money, then obviously I shall be charging something from you. So that can be interest or that can be anything in any format, but the valuation should be more than what I have already given you. This is the reason why people do fixed deposit, because if they deposit 1 lakh as FD into any bank, then the bank gives them the fixed rate of interest. Okay. So as the investors are giving you their money, so they are expecting something in return, and their expectation ultimately becomes your cost of capital. So I hope you have got the idea regarding what's the cost of capital is. So this is all about that. So in this video lecture, we shall be talking about this in detail. Each and every element regarding cost of a capital is going to be covered in this video lecture. So I hope you have got the idea and structure. Now I'm just going to share the screen with you. I hope you would enjoy that. Just to see it. All right. I hope you are watching this video lecture right now, and the screen shall completely be visible to you, as the name of the topic is written cost of capital and leverage. So in two parts, this video lecture shall be delivered. First, we shall be talking about the cost of capital, and after that, leverage shall be studied in detail. So we have taken so many lectures regarding financial management in which all the basics have already been taught to you. And all the previous videos are prerequisite uh, for seeing this video lecture. Okay, so if you have the knowledge of basics of a financial management, the videos of which have already been delivered, like the objectives, and after that we have talked about the sources of finance, and most important and the recent chapter and topic which we have covered, that was regarding capital structure, and most importantly the capital structure theories, in which we have studied the concept of a firm being levered in detail. Okay, so we have talked about what should be the best and optimum mixture of equity and debenture in the capital structure of every company, so that two objectives can be attained. The first objective was the maximization of the value of the firm, and the second objective was the minimization of the cost of capital. So as far as the value of maximization of uh, value is concerned, this is usually not in your hands. Okay, this is usually not in your hands. The reason being, uh, it can be done on the basis of the mixture of debt and equity, and you never know that what in what way and how shall the market behave as far as your company and your products are concerned. So maximization of value is comparatively not in your control, but minimization of cost is always in your control. You can decide the optimum equity and a debt structure in which the minimization of cost of capital can be assured. Okay, so all these things we are going to talk about basically and broadly. There are four kinds of uh, the different capital structure elements for which we have to calculate the cost of capital. Okay, so what do you mean by cost of capital? First of all, if you ask me this question, this simply means, then obviously, as I have already given you the idea of how a business is started and how the funds can be raised. So this is your business, this is your idea, and there are investors who are going to invest into your business. And the first option could obviously be the equity share capital, and the second could be the issue of preference share capital. The third can be the use of or pluffing back of profits, that is known as retained earning. And the final thing is the issue of a debenture, for which we have talked about in detail, obviously. So all these things are the avenue. So whatever the investor or whoever the investor is investing in your business, they are obviously expecting something in a return. So why do you make fixed deposit in bank? Obviously for the sake of earning the interest rates. Okay, so why are equity investors or why are shareholders investing in your company? They wish to have dividend income. Okay, they wish to have a dividend income. Why preference shareholders are investing in your company? Obviously they are expecting the fixed rate of interest or a dividend. Why are a retained earning being used? These retained earnings also uh, goes to the equity share capital. So this, they also do possess some cost, that is dividend. And why venture holders are investing in your company? Only for the reason of earning the interests. Okay, so whatever the return they are expecting in a return of employment of their capital, that expectation ultimately becomes your cost that you have to bear. Okay, so somebody is giving you money. Okay, suppose somebody is giving you money 1 lakh rupee today, and you are using their money, then they are letting you use their money only for the reason, then when you shall return their money, you shall not return only the principal amount, you shall return the interest as well. So that can be 5%, that can be 6 or anything. If this is 5%, then that means you have to pay or repay them 1,05,000. That means 5,000 is their interest income. In the same way, if any investor invest in your business, then they expect something in return, and that expectations of them becomes your cost of capital. So this is all about that. Okay, so in this chapter what we have to study, what do we mean by cost of capital, and after that how this is calculated. How this is calculated individually, I shall teach you how the cost of debentures is calculated, how retained earnings cost of calculated, how cost of preference share capital is calculated, how the cost of equity shareholders is calculated, and finally the most important thing, how the weighted cost of capital is calculated. Okay, so that is cost of a weighted capital, the somewhat illustration of which we have covered in the capital structure theories as well. Okay, so weighted average cost of a capital can be considered to be the overall cost of capital of the firm, because our purpose for study of a capital structure was ultimately to reduce the cost of a capital or weighted average cost of a capital. So today in detail, we shall be talking about their calculation and their relevance in order for the further decision making. So if you have got the idea of this one example or illustration given by me, then obviously calculation and understanding regarding these all the elements becomes very easy for you. So now one by one, I am going to talk about all these, and one thing to make you clear that from exams point of view or net GRF exam point of view, what we have to study, we simply have to study their calculation method. Okay, calculation method and their formulas you have to remember. You have to you can say, you can cram, or you can do anything, but I do not suggest to solve the practicals for that, because if you start solving practicals of these are very much in large, and that these shall consume so much time of you. The exam is not concerned about solving the practicals, but that is concerned about your understanding, and your understandings become very clear if you go through from all these concepts individually rather than solving the practicals for each concept. So what should be your strategy? Your strategy should be to understand the formula, what the structure has been used in that, and just remember that formula. So that would be more than sufficient. If you remember the formula, you can easily put the values in the formula and you can solve any kind of questions. So just going to share further things. Regarding cost of capital, I have already taught you that cost of capital is a return on investment expected by all stakeholders who have contributed their capital in the company. So whoever has invested, they need something in return, and that return is return on investment. Cost of capital includes cost of debt, cost of preference share capital, and cost of equity. So three are the major cost of retained earning. We shall also see that. We'll study calculation of different sources in the following points. The first, we are going to talk about the cost of debt. Okay, so when we talk about the cost of debt, that means cost of a debenture, and it should be studied into two parts. The first are irredeemable debt or debenture, and the second are redeemable debenture. Irredeemable debentures are those debentures which the company is not supposed to, or this is not obligation for the company to redeem within a specified time frame. But redeemable debentures are those debentures which the company has to redeem after the given period of time. For example, if a company has issued the debenture for 3 years, that means after 3 years it has to repay all the money back to the debenture holder. So this is called redeemable debentures. And irredeemable debentures are those for which the company is not supposed to repay them back, because this is already written in the policy papers. So first we shall talk about how to calculate the cost of irredeemable debt. So irredeemable debt is debt which company is not going to redeem or repay until winding up of the company. Its cost could be found in two ways. Okay, the first, it can be cost of debt before tax, and the second shall be cost of debt after tax. So cost of debt before tax is calculated by dividing interest with the net proceed of debenture. I hope you understand the point. So how we shall write? We shall write cost of debenture as KDB. Here D stands for debenture, B stands for before tax. And how this is calculated? This is calculated as interest divided by net proceed. So what is interest? Interest is the amount which you are going to pay them after a specified period of time, like 5,000, 10,000, or 15,000, or anything. That can be interest. And net proceed is the net amount which you have raised when you issued them the debenture. It can be 1 lakh, 2 lakh, or anything as per the question. Okay, so this is known as a net proceed. Okay, so KDB stands for cost of debt before tax, and I stands for interest to be paid, and NP, net proceed received from issues of debenture. The next are cost of debt after tax. Okay, so when we talk about cost of debt after tax, what we have to do, we have to take into consideration the tax rate as well. So how this is calculated? So so we can see that it is written as KDA. Here D stands for debenture and A stands for after tax. So when we talk about this, so its formula is simple, and this is just an extension of the cost of debentures before tax, and this is adjusted for the rate of taxation. And how this is calculated, it is very simple. I'm going to explain you. This is interest divided by net proceed multiplied by 1 minus tax. Okay, so suppose your interest is 5,000 and your total net proceed was 1 lakh. Okay, so it should be adjusted with the tax. Like for example, the tax rate was 50%. You have to write here 0.50, and when you shall solve this equation, you shall get the value of cost of a debenture after tax. So KDA stands for cost of debt. Here should be after tax because A has been written. Then I is interest to be paid. NP stands for net proceed received from issues of debentures, and T stands for tax rate. And this should all be your strategy to understand and to go through for the cost of debentures. So I hope you have got the idea of how the cost of irredeemable debt is calculated. So if you have calculated it, so now you can easily proceed for the calculation of redeemable debt. So regarding redeemable debt, I have already taught you that these are the debt which the company will redeem after a specified period of time. Okay, so its calculation can also be done in two ways. The first is the calculation of redeemable debenture before tax and calculation of uh, redeemable debt after tax. Okay, so when we talk about before tax cost of redeemable debt, what we have to do, we have to write here KDB. KDB stands for cost of debenture before tax. Okay, here B stands for before tax, and its formula should be I stands for interest plus 1 divided by n. N should be the actual number of years for which the debentures have been issued. Like for example, these can be issued for 2 years, 3 years, 4 years, or anything. N should be there. Then these should be multiplied by RV. RV stands for a redemption value, at how much price you are going to redeem. Suppose you had at the time of issue of debentures, you had raised 1 lakh rupee. That 1 lakh rupee will be your net proceed, but the value at which you are going to redeem those debenture, maybe that is 1 lakh 5,000, maybe that is 1 lakh 10,000, maybe anything. That should be your redemption value. Okay, so this all equation should be divided by 1/2 of redemption value plus net proceed. So when you solve this equation, you shall get the value of cost of a debenture before debt, before tax. Okay, so I hope you have got the idea, complete idea of how you have to solve this. Never ever in the history of examination the solution of this was asked, but I must tell you, you have to remember the formula, because the exam can ask you how to solve the before tax and after tax cost of redeemable or irredeemable debt. And now we talk about the cost of debt after tax. Here A should be specified. I think some kind of typing mistake was there. Its solution is very simple. Okay, so all the equation is always the same, like equation which we have used to calculate the cost of redeemable debt before tax. All the equation should be same, no changes there, but the only changes I should be multiplied with the value of 1 minus t, and t here stands for tax rate. Okay, so this is the only difference, otherwise all the formula is same. Okay, I hope to each individual item you would have understood the point. I stands for the interest rate, T stands for the tax rate, N stands for number of years for which the debentures have been issued. RV stands for the redemption value and NP stands for the net proceed, the proceed which you have got at the time of issuance of these debentures. So it was all about that. I hope you have got idea. Now we are going to move further and let's see. I think the first portion for the calculation of cost of capital, that was cost of debenture, that is over. So now we shall talk about the cost of a preference share capital. Okay. So regarding preference share capital, we have already delivered a detailed lecture in detail while talking about the sources of finance. We have covered this topic. And now I shall teach you how the cost of preference share capital is calculated. So preference share calculated are capital is also issued on two bases. The first is the redeemable preference share capital and the second one are the irredeemable preference share capital. So when we talk about the redeemable preference share capital, these are the preference shares which are to be redeemed after a specified period of time, like 2 years, 3 years, or 4 years, or anything as specified by the company policy. And the irredeemable preference share capital are those shares which are not bound to be redeemed for any given period of time. So when we talk about both of these, we have to understand the cost of a preference share capital on the basis of these two types of preference share capital. So one by one, I shall be teaching you both of these. The first is cost of irredeemable preference share, and this is found on the basis of formula, on the basis of the following formula. Here KP stands for cost of a preference share capital, and how this is calculated. Here D stands for the dividend per preference share. Okay, so it can be any amount. Okay, so it can be any value which you are going to pay as a dividend to preference share. So NP stands for the net proceed, the proceeds which you had raised at the time of issuance of the preference share capital. So this is all about that. I hope you have got the idea of how you are going to calculate the irredeemable preference share capital, cost of capital. So when we talk about the cost of a redeemable preference share capital, how this should be calculated, its calculation is exactly same as the calculation of redeemable debenture was there. Okay, so there we used to write I. Okay, but here we have to write D. D stands for the dividend which you are going to pay to your preference shareholders, and after that here should be the sign of summation, and after that here should be half of the maturity value minus net proceed. Here maturity value is exactly same as what redemption value we have understood. Okay, in the case of debenture share capital, and this all equation should be divided by 1/2 of maturity value plus net proceed. So I hope you know the meaning of each and individual item covered in this specific topic. The first is D stands for the dividend per preference share. Then MV stands for maturity value. This is also equal to redemption value, as was the case of debentures. And NP stands for the net proceed. One mistake I think I have committed here. I should have written 1 divided by N, that is number of years for which the preference share have been issued. So you are not supposed to commit these kind of mistake, because these can cost you severely. So all the formula is same, but here if we write I, then that formula shall become the formula for the cost of redeemable debenture. But when D is written, then it becomes the formula of cost of redeemable preference shares. So I think that was all regarding these. So when we talk about the existing debt, so this is as from the point of view of a calculation of a cost of a capital, although the books suggest only three things to be studied, like the first one are debenture, then a preference share capital, then equity. But we have tried to cover as maximum as topics as possible so that nothing is left from exams point of view. The first one is cost of existing debt. Okay, the debt which is already lying in your books of accounts. So here is a balance sheet. So in the balance sheet, the first here comes the equity share capital, preference share capital, and there is existing debt, like this can be loan, this can be debenture, this can be anything. So how the calculation of the existing debt is done? So this, so formula for that is almost similar to what we have covered for the cost of debenture. So if we talk about this, so this is also same as what we have gone through previously. So its calculation can again be done on the basis of two ways. The first is before tax cost of redeemable debt and after tax cost of redeemable debt. So when we talk about cost of redeemable debt before tax, we have to write KDB, and uh, interest should be added in one half of redemption value minus net proceed, and this all equation should be divided by one half of redemption value and net proceed. So this is going to be the formula for the existing debt which is already lying in your books of accounts, and that calculation is done on the basis of before tax. And when we talk about after tax, what you have to do, a very slight difference is there for the calculation of cost of debt after tax. This is, you have to adjust interest for the tax rate, and how this is adjusted, you have to write I then bracket open 1 minus t, that is t stands for tax rate, and then bracket is closed. So if I is 5,000, so you have to adjust it according to the tax rate applicable. If this is 50%, then 0.5 should be there, and then ultimately your interest shall be reduced to 2,500 only. So this is I stands for interest, this is T stands for your time period. So T stands for your tax rate, N stands for number of years for which the debentures were issued, R stands for your redemption value, and NP stands for your net proceed. So this is all about that. I hope you have got the difference between this as well. So a lot have already been studied and discussed in this video lecture. So now what we are going to cover, that is going to be regarding the calculation of cost of equity share capital, which is very important from point of view of examination. So cost of equity capital do not possess any kind of a specific formula. There are so many formulas which we have to learn, which we have to understand from the point of view of equity share capital. But first of all, I would like to recall your understanding regarding equity share capital. So they are the real owner of the company, and they get paid after each and every investors has been paid by the company. So finally whatever they get the value for their investment, and this is also known as a dividend. Okay, so obviously the first cost, the name of the cost of equity capital is always the dividend, because you have to pay them a dividend. So there are number of methods for finding the dividend cost of equity capital. The first method is a dividend yield method or price ratio method. It has two names. The first is DYM, this is dividend yield method, or this is also known as price ratio method. So in this, the minimum rate of cost of equity share will be equal to the present value of the future dividend per share divided with the current price of the share. So you would not be getting this idea by merely reading this line. What we have to do, we have to understand it in this way. So what you have to do, you have to write here the dividend on the numerator. Okay, so this is going to be the dividend, and it should be divided with either net proceed, which you had received at the time of issue of equity share capital, or it can also be divided with the market price. Okay, so what the line was telling you, that was the present value of future dividend per share. So this was dividend per share divided by current price of the share. Current price of the share could be the market price. So that is all referred to as KE, and KE stands for cost of equity. So cost of equity is equal to expected dividend per share, that is to be written on the numerator, and net proceed or market price can be written on the denominator. So this is all if you want to understand regarding dividend yield method. The second one is the dividend yield plus growth in a dividend method. So every in year on year basis, the company sometime expects the growth in their dividends. Okay, so they have to account for that growth in the calculation of cost of equity. Okay, so how this is adjusted? This is adjusted on the basis of this formula. So this is basically, it can be found on two bases. If you remember only the first formula, that would first formula, that would be suffice. Okay, so D1 stands for the dividend you are going to distribute, and that should be divided by NP, that is net proceed, the proceed which you had received at the time of issuance of equity share capital. G stands for growth, whatever the growth rate of growth you are expecting in the dividend. It can be 5%, 10%, or anything as per the expectations of the company. So I hope you have got the idea. There was only few difference between the first and the second formula. D1 stands for the dividend rate of the at the end of the current year, at the end of the current year. But D0 stands for the dividend of the previous year. Okay, so this is for current year, this is for previous year. So why 1 plus G is written? The only reason being, you have to consider the growth rate of a current year as well, if you are calculating the cost of a capital on the basis of a dividend of a previous year. So that was the reason. Otherwise, all the formula is exactly same. So D1 divided by NP plus G, that is the rate of growth the company is expecting in dividends in the upcoming years, is to be recorded. So this is the calculation of the formula of cost of equity capital on the basis of a dividend yield plus growth in dividend method. The next one is the calculation of cost of equity on the basis of earning yield method. Okay, earning yield method. So on the basis of that, cost of equity should be calculated as earnings per share divided by net proceed or market price share. Earning per share I have already taught you number of times, because I believe that you would have understood, you have gone through from the video lecture of capital structure and its theories in detail. I taught you EBIT minus interest. After that, here should be EBT, and EBT should and after that, tax should be subtracted from EBT. So that remains the earnings available for equity shareholders, and when these earnings are divided by number of equity shares, you get the earning per shares. And when this earning per share is divided by net proceed or market price per share, then you can easily find the cost of equity capital. And this is the very important formula. If the question is asked, then this specific method is highly expected. Then the next are the cost of retained earnings. Okay, retained earnings I have taught you so many times. Right now, retained earnings are just the pluffing back of profits. We do that, these kind of things, because generally And these are the norms, or this is very general code that the company need the investment from time to time. And instead of relying upon the external sources of finance for the next investment, they rely upon the internal sources of finance. And how these internal sources of finance can be used: so instead of issuing the further share capital, whatever the earnings they have made in the current fiscal year, they are not supposed to distribute 100% of that. They just retained something, some of the part of that, so that if there are further investment opportunities, these funds could be used. So what they have to do, they have to use their retained earnings. So retained earnings also possesses some kind of a cost, because ultimately retained earnings forms the part of the total wealth of equity shareholders only. So their calculation is exactly same as there was the formula for calculation of a cost of equity share capital plus growth. So KR stands for cost of the retained earnings, that is dividend divided by net proceed plus expected growth rate. Okay, expected growth rate. Why same formula as cost of equity capital? I think you have already got the idea that retained earnings also belongs to equity share capital or equity shareholders. Okay, so this is why the reason their formula is exactly same as cost of equity share capital. Then its formula: if the brokerages are there, brokerages, sometimes the company charges brokerage as well, or this is charged to the company as well. So in that case, if the taxes and brokerages are to be adjusted in the cost of retained earnings, then how this is to be done? First of all, the first part shall remain the same as previous one, and after that tax should be adjusted. This is 1 minus tax, and after that brokerage should be adjusted. This is 1 minus b. Okay, so hope you have got the idea regarding brokerage fees. Okay, so whenever the company has to issue their share capital, they cannot perform all the duties alone. They need the help of some brokerage firms. They charge from the company for making flotation of their capital in the market on their behalf. So these kind of charges are to be adjusted for the cost of retained earnings as well. So now finally we have talked about each and every element in detail. Okay, I have talked about the debentures, then retained earnings, after that preference share capital, cost of existing debt, and most importantly the cost of equity share capital. So these were the individual portion or part of the complete capital structure of the company. But when we talk about the capital structure term, then we usually refer to all the elements containing in that, not separately, but in joint form. So for joint, if we are calculating the cost of capital of all these elements, not individually, but in a combined manner or joint manner, then this cost is known as weighted average cost of capital. So what happens? You have equity, you have debentures, you have preference share capital. Okay, so they will be having some weights in the proportion, because you know the total capital is 100. Okay, the rate or the weight of the total capital in your company is always 100. Maybe you are using 50% of equity, 20% of debenture, and 30% of a preference share capital. When you have calculated their individual cost of capital, like supposed for equity that comes to be 10%, for debenture that comes to be 8%, for preference share capital it comes to be 10%. You have to multiply weight with the individual cost of capital of these sources. And when you have done that, whatever the value you get at the end, that comes to be your weighted average cost of capital, and that refers to the total cost of capital from all sources of funds, the weighted average of total cost. Okay, so KW, which we have referred so many times while studying the capital structure theories as well. So weighted average cost of capital is a calculation of firm's cost of capital in which each category of capital is proportionately weighted. So this is all that. Okay, how this is calculated, I have already taught you. Sum of XW. X stands for the individual cost of all the sources of finance, and W stands for the total weights, and these should be divided with sum of all the weights. Okay, so when you solve this equation, you can get the value of weighted average cost of capital. After that, one formula which has been asked one or two times in the examination, that is capital asset pricing model. Okay, so this is the model that describes the relationship between systematic and expected return of asset, systematic risk and return. So this formula tells you the risk and reward or a return relationship when you have invested your money in securities, in any kind of a projects. Okay, so how this formula is done, it tells you that your cost of individual investment, like that could be equity capital or any format in which you have invested, if you find its value on the basis of CAPM model, how you would do that? This is a cost of equity capital is equal to risk free rate of return, like it can be 10% or anything. Then this is beta 1. Okay, this is beta coefficient of firm's portfolio. This is risk rate. Okay, this is risk rate or the beta rate. Beta is fluctuable rate or variation rate, you can say. Then RM stands for market return for the diversified portfolio, and RF again stands for the risk-free rate of return. Okay, so in combination, the cost of equity capital is the can be divided into two parts on the basis of the model CAPM. The first part is a risk-free rate of interest or rate of return, and the second part, this whole part, stands for the risk premium. And how this risk premium is calculated, when you get the value of uh, return, market return minus risk-free rate of return, this ultimate value or the conclusive value should be multiplied with the beta factor. Okay, beta factor, this is the factor, like it can be standard deviation, it can be variation, or it can be found by using any formula, statistical formula. When you solve this equation, that equation refers to the risk premium, and when you add risk premium in the risk free rate of return, then these both in combine makes up the total cost of equity share capital, and this is all about CAPM model. Finally, there is the last method for pricing of the investment avenues or opportunities. This is the arbitrage pricing theory. This is a multi-factor asset pricing model based on the idea that an asset's return can be predicting using the linear relationship between assets expected return and a number of macroeconomic variable that captures the systematic return risk. So you would not get this detail. Okay, so by just merely or looking at that, you would be getting the idea by looking at this. So this is known as the expected return on a specific asset, that stands for R. R is the risk-free rate of return. Then here all the B's stands for the parameters of the equation, and these are the sensitivity of assets price to any factor. Okay, to any factor. So this is for factor 1, factor 2, factor 3, factor 4. So this is sensitivity or the variability or standard deviation. These are beta coefficients or parameters of the equation. And finally, this is risk premium associated with factor n. So this is risk premium RP1 for first factor, RP2 is second factor, RPn for n factors. Okay, so this arbitrage pricing theory, it just tells you that the valuation of the cost of or the expected return can be calculated on the basis of linear equation uh, of the all the elements which can affect the return of a specific investment. Okay, so you can see that we are trying to calculate the return for asset J. Okay, so assets J return could be found out on the basis of this equation. This is risk free return. These are all parameters. These are found on the basis of the statistical formulas. These are risk and the next one are risk premiums associated with different variables. This is variable number 1, this is variable 2, variable n. So this is all about that. The most important thing is the arbitrage pricing theory was developed by Stephen Ross in 1976, and that was an alternative to CAPM. And from that, highly in the literature of calculation of the investment returns, this formula is used. So I hope I have taught you a lot of things in this video lecture. You would have got the complete idea of what to go through and what to do. So the next topic shall be regarding leverage, and after that systematically we shall be covering all the topics in the financial management as soon as possible. Thank you so much. This is Gurpal Singh from Gurpal Education.